All right. So how does private lending work? So
Case example, Mike, or how do you want to go about this?
let's talk it out, and then maybe we could show some examples. Actually, let's do that first. Let's define it, then we can jump to the sheet that we have to kind of work it out.
Sure.
So the concept of private money, it's kind of simple, right? You have lender, you have borrower, and then you have paperwork. For the most part. And the way it works is if there is a deal that you're going to do, and you already have your borrower lined up, and you have your lender, or the borrower already has a lender lined up. So the borrower is the real estate investor in this example. He has a nice property. He runs it by his private lender. Lender's interested. They agree to whatever the terms of the deal they agree, interest rate, any points, length of the term. And usually what happens is, all right, private lender and the borrower go to a closing company, and it's going to vary by state if it's attorney or title company. And then the title company can draft up the mortgage note paperwork for you based on your agreed upon terms. Let's just say it's 0 points, 10% interest, 12-month term. That would be typed out in the promissory note. And then the mortgage will be part of that deal as well once it closes. And that would be my recommendation. Have the professionals handle all the paperwork there. The lender actually would lend or wire the money to the title company. If it was a title company handling the transaction, I wouldn't recommend sending it to the borrower and then vice versa. Keep it clean, go right to the title company. Great. And then you close on it. And, communication throughout the project would be key too. Mm-hmm. And once you're done rehabbing it and listing it, let's just say, and you close on the property, then at the close, the private lender will get their money back. And let's just say this deal was simple. It was principal plus interest, but they just wanted interest at the end. So there wasn't interest payments at the end or throughout the time period. And in that example, the private lender would get, whatever they lent times whatever interest rate they wanted over the length of the period. If it was 6 months, it would be 6 over 12, basically, is your interest amount. So that's kind of like the simple example there. Anything I missed there, Paul?
No, you hit the nail on the head with it there. And the only other thing that we would do when we're securing, besides the deed of trust or mortgage, depending on what state you're in, would be adding them to the homeowner's insurance policy as, mortgagee and loan loss payee, basically, on that. Just so they're secure on all ends. They know there's homeowners insurance against the property in case something happens. Like we had one, right, where pipes burst in our property in Michigan. Yeah, we have a private lender on that, but we're getting an insurance claim on it right now, and then we'll fix it up and then resell it. But the private lender probably gets notified that we're having a claim against that policy as well, but I already let them know.
Yeah.
Sidebar. But they have that for security, right? You want to make sure that they're covered just in case the place burns down or whatever, that they're going to have their money back.
Yeah, that's a good point. And then the only fees really associated with the private lender is the wire transfer for the most part.
Yeah, wire transfer and the mortgage recording.
The mortgage recording, which that varies by county usually, I believe.
Right, and if it's going to be a really short-term one, some private lenders, like I use a couple different ones that don't want it recorded because then they have to do a mortgage satisfaction piece, which is another piece of paperwork that's signed, get notarized, send in, and pay to get recorded. So if it's a quick turn, like a lot of ours are, Mike, a lot of times that's not even recorded. It's just held. They have a copy of it. The title company has a copy of it just in case.
Yeah, good point. All right, so I'm going to stop my screen share and jump to another. All right, Paul, can you see this kind of an example here?
It's up here.
Yeah, so you want to do a rental and a fix and flip, two-part example maybe?
Perfect.
Yeah. Again, these are mythical numbers, but let's use what I got in here for the most part. And let's just say a person's going to do a single family BRRRR strategy. So buy, renovate, refinance, repeat type of thing, rent out. And the purchase price is 60. Renovations 35. So the funding needed for an investor, excluding some closing costs and things like that, initially would be 95 for the deal, just to keep it simple, purchase price plus renovation. So that's something that you need as a real estate investor, aka borrower from a private lender.
Right.
Now, the lender deal, this is probably a quick example here, 4 months, but let's just go with it because that's what's in here. If the lender has interest here, it's pretty simple. It's this times whatever interest rate you have is 10% over the 4-month period. And that's going to equate to $3,167. If you charge a point, that would be the point there on the loan. If your holding cost or $1,000 during this period, you're all in from an investor perspective, a borrower perspective, you're going to be at a little over $100K. If your after-pay renovations on the single family are $150 and you use a 70% loan to value ratio, so like you could, cash out your higher interest rate private lender, this is what you could take out 70% of $150. So now you, the investor, on why you're willing to pay the higher interest up front, you actually can, with this 105, pay out your lender their 105 plus their interest and points, and you're going to pocket yourself here after even your holding costs of another $4,000.
Yep.
And then this is, your monthly payments over 7% in 15 years here. If you got rent of $1,400, you're now cash flowing basically this much money a month on a newly renovated property.
Yep, that's your ideal type.
Exactly. So that's like a rental example on how that would work. If we do a buy, renovate, and resell example, let's assume you're purchasing it for $52,000 a property. Your renovations are $45,000. You got transfer tax, lender points from above, closing costs. This is what you're going to need from your lender, $100K basically, knowing that they're going to charge points. So again, after repair value is $150 on this property, that's what you're all in for. You got your lender interest over 4 months again, holding costs, selling costs, transfer tax, closing costs. At the end of the day, by paying 10% in a point, this deal made sense still because you walked away with $34,156. Yep. So just a high-level example on a kind of a quick buy, renovate, and resell or BRRRR strategy type of property.
Yeah, there's some perfect examples and a win-win for everybody in both examples there.
Yeah.
Good profits, the lender gets something. And let's say something went wrong on the appraisal on the first one for the rental, right? And they had a difference of, say, $10,000 that they had to make up. Well, maybe your private lender is willing to hold a second at $10,000 for a period of time, and then you just make payments on that too. So there's flexibility too. Some lenders will like that. Some lenders don't want to do that, but that's something you can do. And I know there are lenders out there. A friend, our Corey, right, utilize them for second mortgage lenders out there. So there's definitely people that want to just earn a nice interest rate return on their money. So there are those people out there. So you can continue to utilize them. Don't necessarily worry about like if I'm short, do I have to come up with money to pay them off? Maybe you do, but maybe you don't. You got flexibility.